everyone should have that conversation and build a strategy that fits their needs and their risk profile and risk tolerance with those different buckets that you kind of have and different irons that you're putting in the fire for yourself for retirement.
Hello, fellow investors. Welcome to another episode of Ritter on Real Estate, where we teach you how to passively invest like a pro. Today, my guest is Corey Daharsh. Corey is a business development specialist at Advanta IRA. Corey, welcome to the show.
Yeah, Kurt, thanks for having me on the podcast. I appreciate the opportunity.
Corey, this is one of my favorite topics to spread the word on. I'm always surprised how many accredited investors are unaware they have this tool at their fingertips.
No, I really couldn't agree more, Kurt. It's really only about 4% of retirement accounts are being self-directed. And Advanta was founded in 2003 with the principle that people should take a proactive approach with their retirement savings and actually invest in things they know and understand, as opposed to the traditional stocks, bonds, and mutual funds people tend to favor.
Wow, only 4% of people are self-directing their retirement accounts. Did I hear that right?
It's not 4% of people, it's 4% of the total retirement dollars in the US. So there's a statistic I've kept track of. The total balance of US based retirement accounts is somewhere tickering right around 37 and 39 trillion dollars, and only about 4% of that total are invested in self-directed accounts. So a lot of education and networking is what we try to do to expand the knowledge and understanding. So again, I appreciate you having me on the podcast to just pass along a little of the information I have.
Yeah, for sure. I mean, most of the calls that I'm on a weekly basis, this topic does come up, and it's foreign to almost everybody, that I'm communicating with. So I know it's a topic people are eager to learn more about. But before we dive into that, do you mind giving us just a little bit of your background before Advanta and then your time with Advanta?
Yeah, of course. So I've always had an interest in kind of the banking and finance world, if you will. When I was in high school, even as a sophomore and a junior, I was taking accounting-based classes and on an accounting academy track. I went into college with the intention to double major in business management and accounting, and decided after my second year I was not wanting to pursue accounting as a day-to-day activity in my life. So I stayed through with business management, took a few leadership and entrepreneurship classes. As soon as I graduated, I started with a small tech startup company. I was the third employee hired. I worked out of the guy's house for a little while, and I worked there for about 2 years, and it just never really materialized the way I was promised and the way it was supposed to. So I started looking for different opportunities, and I found Advanta IRA, which was a great, for me, fit back into the finance world. I put myself through college working in banks and credit unions, so it was a great way to get back into that world, but actually have a little bit more of a career path than just being a bank teller for 10, 15 years or trying to work my way up in a bank branch. So I've been with Advanta since 2016. I started as a client account manager, just on the backside, processing transactions, helping the accounting team. And then in 2020, I moved up to Western North Carolina, where I live now, and transitioned to business development, where I do podcasts like this, a lot of educational content, a lot of networking, just to really expand the knowledge of these self-directed accounts, how people can utilize them, and just pass along the expertise I've built for myself over the past 6-7 years.
That's awesome. I love what you said, the expertise you built for yourself, because that's been my journey as well. As I've started to invest in multifamily and other alternative assets, a lot of that education and diving down the rabbit hole is just education for myself and my own investments. And what's really great about my job, and I'm sure the same as yours, is you get to just pass that information along on a daily basis to people you're interacting with.
Yeah, it's really a joy of my day-to-day job is learning from people how they're investing. It helps me build my own thoughts and my own opportunities to invest moving forward. And that's something I didn't really come from in a background. My parents, don't have too much of knowledge of investing or things like that. So the more I've actively been in this career path, I've learned more about what I'm actually interested in, what I think I want to set up for my future retirement account and earnings and things like that, and really what I want to pass along to my son, who's only a year old now, but just some of the knowledge and information, and also possibly the assets that I'd like to have him receive later on when, and eventually something's going to happen to everyone. So you've got to have your beneficiaries lined up.
For sure. Well, I'm excited to dive into this. Let's start at the top, right? We'll start very basic. I'm going to use the acronym here, but what is an SDIRA?
So an SDIRA, it's funny that you mentioned an acronym because it can refer in many cases to other types of plans that aren't necessarily an individual retirement arrangement. But let's break it down. SD is self-direction. IRA really just means retirement product. Self-direction in any capacity is you as the account holder making the choices of what you invest into, as opposed to being provided a list of pre-approved investments or a specific stock or bond or mutual fund that someone's suggesting you go into. With a truly self-directed account, you are the fiduciary and you're making all the fiduciary decisions of your own retirement dollars. So you may hear, hey, we have a self-directed product at those larger wirehouse custodians, but it really just means that they've done some due diligence on maybe 15 or 20 stocks or mutual funds and let you choose from those specifically. A real self-directed account like Advanta offers, whether it's an IRA, a Roth IRA, a solo 401k, or some other plans like health savings or education savings accounts, just allow you to invest into exactly what you want to, as long as it doesn't run afoul of the IRS rules, which are very simple. No life insurance investments and no hard to value collectibles like antiques or fine wine, artwork, anything that the IRS would consider subjective in value are things that you cannot hold in your retirement account. Anything else outside of what I just described, you likely can structure a way to hold it with your retirement dollars.
Okay. A lot to unpack there. I love it. The main thing I heard there was, right, the SD stands for self-direction. Why do you feel that so many people are unaware that they can self-direct their retirement accounts? Why are more people not taking advantage of this? Just in your professional opinion, from what you've seen, since being there from 2016.
So a key factor is that most people set up their accounts with those larger custodians that they may know more about. And those custodians have a vested interest in the clients not pursuing self direction. A lot of times, when we're working with clients in the onboarding side, they may say, oh, my advisor told me not to self direct, not to do this. Well, that is because their vested interest is keeping your dollars with them so that they can charge you a fiduciary rate or fee, whatever it's a flat rate or a percentage of the investments they make on your behalf. So part of the reason is we're battling against those larger companies that do have fiduciary capacity. It's not a product for every single person out there, but for those that learn about it and can decide if it's a good product for them or not and take the control, it's really a strong tool once they learn that it exists. Even if it's not for someone, if they can pass along the information to their family member that's a house flipper or someone they know that does syndication investing, that just doesn't know they can also use their hard-earned retirement savings for it. It's really just a unique tool that more people should know about, and that's what our job really is on my team and on my side, is expanding that knowledge and information as best we can.
Okay, let's talk about, you mentioned these larger custodians, and we'll get into all the players here. But what would be an example of some of these larger custodians, just so people might be able to put a reference to what we're talking about here?
Yeah, I'm referring to, your T. Rowe Price, Edward Jones, Merrill Lynch, Charles Schwab, Vanguard, those types of larger companies. Nothing wrong with any of them. They are great at what they do. I have an account with one of those companies for diversifying my own retirement account portfolio, but they tend to favor shying away their clients from self-direction or telling them, hey, that's not a good idea. Again, because they have a vested interest of keeping as much of your dollars with them so that they can earn off of that money as opposed to letting you drive your own returns with your expertise.
Correct. Yeah, I agree with that. What would you say, if you had to, boil it down, are the main benefits of a self-directed IRA?
Control and the tax benefit. So when you're talking about making investments with a self-directed account, you're talking about utilizing a tax shelter that the government provides, these IRAs or 401ks. It's a tax shelter that the government provides for you. And making investments with it allows you to grow your earnings within that tax shelter, whether it's a traditional account and you're deferring the taxes to later in life when you make a distribution, or a Roth account where you've already paid taxes on those dollars and let it grow completely tax free moving forward. These types of things are exponentially better in some cases than making these investments outside of retirement accounts where you may be subject to capital gains or other types of taxes that apply with your actual savings account and just your personal wallet, if you will, where the retirement account's sheltered from some of those.
Yeah. And I think, for me, the way I look at it, let's say you're 35 years old, which I'm not, but let's take a 35-year-old who might have 20 or 25 years until retirement, right? When I look at that time horizon, that's the longest time horizon of theoretically money that they won't be able to touch or access until retirement. And not having the ability to put some of that in alternative investments, like real estate, and taking advantage of those institutional quality assets to really diversify your portfolio. That's, the biggest kind of, shame here is that people miss out on that diversification piece or chasing what I think is one of the highest risk adjusted returns in the market with something that they have the longest time horizon on.
No, I couldn't agree more. And just further to that point, my wife and I are pretty much in that age bracket you just referenced. She'll be 32 in a few days, and I'll be 32 later this year. And we really, because of my career path and what I do now, we really have taken what we think is a great grasp of that next 30 years, 40 years that we're going to be working and we're going to keep setting money aside to the best of our ability. We're going to pay taxes on it and let these investments be made in a Roth capacity. And it's just really, I I feel so privileged to know how to do some of these things and share that information again because I didn't come from a background where that was common, and I'm able to pass this information along to those in my own age bracket, some people older than me, some people younger than me, and it's very helpful.
Yeah, I couldn't agree more. Um, what are some examples of alternative investments? We hear this word all the time that really self-directing your retirement accounts allows you to access alternative investments where the larger custodians, right, are more traditional in the mutual funds, stocks, bonds. So what are some of these examples of alternative investments that you most commonly see on a day-to-day basis?
That is a great question because I did go over earlier how wide and diverse the investment strategies can be. A lot of things that we see at Advanta are real estate investors. So I'm not speaking specifically people buying 123 Main Street. There's syndication investing where people are just putting their money up into a partnership as a limited partner, letting the general partner team that they vetted out move forward with the actual day-to-day operations. And they usually get paid out, which I know you're very well aware of, but just explaining to the audience, they get paid out in distributions and then a lump sum at the end of that investment cycle. So we do see a tend of a favor of our clients utilizing those strategies, but there's also people that buy fix and flip properties. There's people that do paper assets, so actually just lending. People actually can be a mortgage lender with their retirement dollars. And then there's other asset classes that aren't as common that we see people jump into. Um, uh, Mineral rights and oil and gas rights, technology. There's a lot of different classes that are kind of popping up right now. Over the past year and a half to 2 years, people have been using their self-directed accounts to get into the crypto space as well. So really, again, just citing back what I said earlier in the call, anything that's not a life insurance policy or a hard to value collectible, if you have an expertise in making money in that field of industry, you could probably have a talk with a self-directed expert and figure out how to structure that investment.
Yeah, I love what you said right there. Your expertise, right? Because you just listed a bunch of different alternative investments. And everybody out there might have a passion or a connection or an expertise in one of those fields, right? And when you have that level of expertise or information in one of those spaces, that feels like a lot more comfortable in a smart investment than investing in potentially a stock, a bond, a mutual fund that you really know nothing about, correct? And I feel like it deserves a part of everybody's overall allocation and diversification.
I agree with you wholeheartedly. One quick kind of anecdote to that effect, I always love bringing up. One of my colleagues, Larissa Green, and I love to do this webinar once a year where we just discuss some of the most unique investments we've ever seen. And I've seen people invest their retirement dollars into thoroughbred horses for horse racing, and even the breeding rights to animals like that. So you can actually invest your retirement dollars, if you're well connected in that community, into the breeding rights for a thoroughbred steed, or maybe a bull for bull riding. Those are types of investments that we've seen with retirement dollars that actually yield great returns for the people that know what they're doing.
Yeah, I agree. Um, so that was a great explanation of all the different alternative investments. And would you say that real estate is the most common? Obviously, there's lots of form of real estate, but in general, that asset class is predominantly what people are self-directing with their retirement accounts.
I would definitely say that. So, not to put a specific number on it, but just in general, real estate investors, I'm talking the fix and flipper and the syndication investor, probably makes up about 60 to 65% of our client base at least. They may diversify and do other assets as well, but just to say as a root like figure, at least half, a little bit larger than half of our client base is doing some sort of real estate investing.
Awesome. And so now that we know all the different things you can invest in with the SDIRA, what are the different types of accounts that you can self-direct? And we'll put a visual up on the screen when we copy and edit this. So I know there's a bunch, right? So maybe start with the most common type of accounts. Usually they carry an acronym as well. So if you think you need a little bit more explanation on all the different accounts you see, that'd be helpful right now.
Yeah, so most people are familiar and understand an IRA and potentially a Roth IRA. Those are retirement accounts anyone can have. You can only add money into them annually if you have ordinary earned income that you pay income taxes on. The contribution limits right now for calendar year 2023 are 6,500 with an extra $1,000, 7,500 if you're over age 50. But that's the most common plan people are aware of and people can utilize. Anyone can have it. You just have to have that earned income. That limit for contributing into it annually is relatively low given some of the other plan types, but it helps you get started. Um, Other plans that can be self-directed that we offer are SEP and simple IRAs. Those are for small business owners, typically small business owners with either no employees at all, no W-2 wage earners under them, or just a limited number. We can provide, more information and guidance on if those plans fit your needs. And then also the solo 401k plan we offer is specifically for those. It's just yourself and or your spouse, no W-2 wage earners. You don't even have to have a business entity set up to qualify for a solo K. You simply have to have income that you're paying self-employment income tax against. So if you're in the infancy of getting your own business off the ground, a solo K plan is a great way to start setting some of your earnings aside. It has a really high contribution limit relative to that IRA I referenced earlier, because you can do an employee deferral, an employer match, and you can also maximize that close to $60,000. You obviously have to have the earned income to support that. And again, I'm sure we'll have a graphic for the audience to kind of outline some of these things, or they could reach out to me if they want to get into it. But our solo K plan also allows for a Roth capacity. So within that solo K, you can build a Roth bucket. So pay taxes on money and let your investments grow completely tax free. If not with the whole balance, at least a portion of it at your discretion. The SEP and simples, like I just referenced, are lesser known but small business owner plans. And then we also offer health savings accounts and education savings accounts. So HSAs, if you're someone that qualifies and has a high deductible health policy, whether that HSA covers yourself or your whole family, those are just two changes to the contribution limit annually allowed. And the education savings accounts, or CISAs, covered out education savings accounts, are for those young ones in your life, whether it's putting them through private grade school or setting them up for their postgraduate education or college level undergraduate. That money can be set aside. It can be transferred to a relative if they don't use the full balance in the account. And again, for people that want these types of accounts that can make more investment dollars out of their self-directed strategies as opposed to the fluctuation and tumultuous nature of the stocks, bonds, and mutual funds out there, it's a great product that not a lot of people even know about.
Yeah, so let's go back to that CISA again. So what I'm familiar with, like most, is the 529 plan, right? That most parents set up for their children. So are you saying that instead of setting up a traditional 529, I could reach out to Advanta and set up a CISA account, and then I'd be able to alternatively invest that in, let's say, a syndication versus the traditional 529 options that might be limited to me?
Correct. So the 529 plan is kind of comparable to the CISA account, but it is not the exact same in the way they function. You can self-direct these CISAs, obviously. The contribution limit, it just to your point of making a syndication investment, the contribution limit for a CISA right now is $2,000. So it would either have to be a low limit syndication deal, or you'd have to be, contributing for a number of years to get up to whatever threshold it may be, or have made a few good investments off your first few $1,000s and built up a balance, maybe tax deed and lien investing, for example, or something like that. But it is definitely a product that facilitates everything you just outlined and compares very closely to the 529 plan.
Awesome. Great explanation of all those different buckets. Let's talk a little bit more about the IRA and the Roth IRA. And I'll just use myself as an example because this is what I see as the most common IRA out there is somebody's left a job and they had a 401k at that job. And let's just say they weren't able to self-direct at that job. Let's say it was through Vanguard and Vanguard did not let employees self-direct. I think that's very common with a lot of those larger custodians, like you said, is they want to keep their arms around that money. And a lot of those big company plans just don't allow for it. So when I left that last job, my 401k was sitting there, and most people will roll that over, right, to a traditional IRA or a Roth IRA. And a lot of people I talk to still have old 401ks out there that are just sitting there. They haven't actually rolled them over to a traditional IRA. So that's really where I start with some of the education. But for me, rolling that large 401k to a traditional IRA was really the first step to unlocking all of those years of underperformance, in that account, and then self-directing it, with my own specialty in multifamily, but also my advisor team and other people that I confide in so that I could figure out how best to diversify that and really jumpstart that retirement account again from all of those lackluster years.
Kurt, I love that example. This is one of my favorite parts of this topic to talk about because I've got my own personal anecdote as well as referring to yours that I can kind of explain and provide a little bit more information. And it's a real game changer and door opener for a lot of people. So, with your example of leaving a previous employer, let's just walk back right there. When you're at a current employer, it's likely you cannot start self-directing that money. That is because the employer has a plan agreement with a custodian, probably one of those larger ones I referenced earlier, and that plan agreement has stipulations. There may be guidelines that allow you to self-direct, whether you've reached a certain tenure with the company or a certain age, maybe sometimes actual retirement age, 59 and a half, or they may not allow that. The question to ask there, if you're someone looking to see if you can start self-directing with a current employer, is are you allowed to do what's known as an in-service rollover? If you can, they'll have more stipulations on that or just guidelines for you at that point. But if you cannot, like Kurt said, you'll have to wait until you terminate employment, and then that money is fair and free game for you. Now, this is the second key point that I love making. When you are going to roll over from a previous employer, don't sit around on that money if you don't have to, because there is a chance, it's not always the case, that the employer pulls you from the profit sharing or benefits pool once you leave employment. So they're not going to hound you to take your dollars away from their pool, but they are going to stop let you benefiting from it once you've left employment. Again, this isn't the case everywhere. You may be with a company that still lets you earn and benefit from that dollars, but some of them don't. For my example, my wife was with the school system in the state of Florida and left the job 3 years prior to me recognizing, hey, you've got money sitting around. It's absolutely not earning a dime for you. Let's roll that over into an IRA, a rollover IRA, as they're commonly referred to. So it's pretty much what you described as well. And once you do that rollover to a rollover IRA, you can move it to a managed account. You can move it straight into a self-direct account. You could break it up and diversify at that point, but it really takes the power into your hands from that previous employer and that old plan that you did have. And it's typically not a tax consequence or not a tax event when you do this, unless you choose to do a Roth conversion and pay the taxes on those dollars at that point, which is a great point to make. It's its own conversation to have with your CPA or tax preparer, though.
Yeah, and just a quick note on that. That's what I actually did, right? As I was educating myself, I took this 401k into a traditional IRA. And then for me, started looking at, all my different buckets of retirement. So when I'm 59 and a half, you want to have different levers that you're able to pull on. Some retirement money that is going to be tax free, some retirement money that will get taxed when you take it. So for me, I rolled a good chunk of that traditional IRA into a Roth, and I had a blend of both, a traditional and a Roth. Now, I did have a significant tax impact by doing that, but I planned ahead. And with my CPA, I knew that I had the cash flow to pay that one-time hit to move it to a Roth. And then now that money is invested in some multifamily syndications, chasing a 2 to 3x, right, on a 4 to 5 year hold. And I'll continue to reinvest that until I get to 59 and a half, chasing those larger returns that I think a lower risk profile. And then also in my traditional and my Roth buckets, giving myself two really great options at retirement.
No, I think that's a great strategy. And just for context, I do want to say once more, I can't provide tax, legal, or financial advice. The explanation you just gave seems like you said, worked with your CPA or tax preparer to build that strategy. Everyone should have that conversation and build a strategy that fits their needs and their risk profile and risk tolerance with those different buckets that you kind of have and different irons that you're putting in the fire for yourself for retirement.
For sure. And I like what you said at the beginning there is, a lot of these larger custodians, they're not going to, send you tons of notifications to roll this over to an IRA where you can take control of it. And that's what I'm seeing when I'm on calls with investors every day is they've just forgotten about it. It's really the last thing you're thinking about when you're transitioning out of an old job into a new job or taking some time off. So I think it's one of the most common things left behind, but it also has such an important impact on the future. So even if that's the only thing from this podcast somebody takes is, oh, I forgot I had that 401k, let's roll it over. That'll be super beneficial.
And that is a tertiary thought, isn't it? I mean, you're moving from one employment to another employment. Like in my wife's case, she was graduating with her master's degree and getting set up with her next career phase. So it was just an afterthought until, me being in my industry, I kind of had a thought one day just sitting on the couch like, hey, did you have a retirement plan when you were working in the school system? Because that was 3 years ago and you worked there for about 3, 4 years. Like, where's that money? What are we doing with it?
Exactly. You said in-service rollover. I like that because there are some larger custodians that if you reach out to them, everybody can reach out to their HR department or somebody at their job. And I love it. That's the question they should be asking, right? It's A, can I self-direct this? Or is there an in-service rollover? And I'm guessing what that means, Corey, is I'm still working at that job, but I can roll over either the entire or a portion of that and then self-direct it from there and almost have two dual programs going, the one at the company level and one that I rolled over. Or is it usually they make you in-service roll over the whole amount? How does that usually play out?
Yeah, it's usually not the whole amount. It's usually broken down into a certain percentage or threshold that they'll allow you to do an in-service rollover of. I always like to think of it in my head as like you're going to Thanksgiving and you see a big turkey. You want to break one leg off of that turkey and give it to your favorite uncle. Well, your favorite uncle might be your own investment strategies, where you want to keep the rest of the turkey where the whole family can kind of eat off of it. And that's kind of the larger wirehouse custodian. They're doing what they do. But you want to break that leg off and give it to the guy you know who's going to appreciate it the most, which is yourself, which is your own ability to drive the returns on that money. In-service rollover, usually they're not going to let you start self-directing yourself at their custodianship. So what we're really talking about when you're doing an in-service rollover is breaking that leg off or that portion off, however much it is, and moving it to what's at that point known as a third-party administrator or a TPA, which is what Advanta would serve in that role, that lets you then self-direct it however you want.
Great segue. But before we get to that, so the example would be if I'm at my old job and I've got $500,000 in my 401k, and I reached out to my HR department and said, "Hey, does our retirement program allow me to do an in-service rollover?" And let's just say they say yes, I could take 100,000 of the 500 in-service rollover that right to a custodian or a TPA like Advanta, and now self-direct that 100,000 into where I feel like I'm an expert into multifamily, while I leave the other $400,000 there and invest in traditional mutual funds and stuff like that. Is that a correct example?
Exactly. Yep.
Okay. All right. Well, let's transition right in. My next question was, who are all these people involved and why do we need custodians and what are custodians and what does it protect us from? I know you mentioned TPA. So we've got larger custodians, smaller custodians, but once again, we'll put some graphics up on the screen. Why don't you simplify it? Who are the players involved and why do they have to be there? What are they protecting?
Perfect. So obviously we all understand that the IRS regulates these retirement accounts. That's a given. Now, the IRS is only going to work with specified companies that are either custodians or administrators. Those terms, for the most part, are interchangeable. They do serve a slightly different role, but for context of the general investor's case scenario, custodian slash administrator basically just means the company that is handling direct contact with the IRS and dealing with the reporting requirements and capacities. In our case, we also, because we're a self-directed administrator, we really heavily specialize our staff in what these rules and regulations are. So our staff, a lot of our staff, goes and gets what's known as a CISP designation, Certified IRA Services Professional. It does require continuing education to keep that certification up to date. I've had mine since 2018, and I again have to do about 30 hours of logged training courses and things like that to keep my certification up to date. But where we serve the role to the general investor is that we're the company that makes sure all your T's are dotted and your I's are crossed per IRS regulation. We do our best to keep you from running afoul of those IRS rules and running into any conflicts where you could do a prohibited transaction or something of that nature. Now, there are still ways that that could take place depending on how you structure your account and your investment strategy and vehicles. But we're here to the best of our ability to follow the IRS guidelines, point you in the right direction of those guidelines, and make sure everything's all kosher with the investments you make, the flow of the cash funds, and everything like that. That's just the relationship between us and the IRS, just mandating your retirement account staying in good order. The other side of the relationship we manage is with your investment providers. So working with the general partner team in the syndicator group or the closing agents if you're going to buy a physical piece of real estate. We coordinate with them just as well to make sure they have what they need on their requirement side, and that the actual investment strategy that's brought to the table when a client walks into our door, calls us and says, hey, I want to accomplish this, is actually done within what the IRS allows and what the investment provider is physically offering as well. So we're not really shaking up anyone's specific role or responsibility or expectation in the grand scheme of things.
Okay, that makes a lot of sense. So essentially, you guys come in as a custodian. So let's use an example, right? So I've got this old 401k, right, that was sitting at Vanguard. I rolled that into a traditional IRA, and let's say now that's sitting at Schwab. Now from Schwab, I want to self-direct that, but I can't self-direct that at Schwab. So I can't just take that money myself and invest it, correct? Right? The IRS says no to that, correct? So that's where a TPA / custodian like yourself, Advanta, comes in, right? So I would open up a custodian account at Advanta, and the money can only go from Schwab over to Advanta. And let's say I decide to move 250,000. I want to self-direct with Advanta. I leave 250,000 in that IRA at Schwab. They're investing in more traditional investments. Advanta is going to invest in alternative investments. And both of those are IRAs, but both of those with those custodians and TPAs get reported back to the IRS. So it shows that I haven't liquidated or touched any of that money and I have penalties to pay, correct?
Exactly. So for you to want to make that self-directed investment with that money, if you took it directly from Schwab, that would be a taxable distribution. You'd be paying taxes on that. Your investment would be made with your social security number as yourself as an individual. And there would be potential, like I said earlier in the call, capital gains and things like that that may apply to the investments you make. Moving it from Schwab to a new IRA at a custodian that allows you to self-direct, it's a very simple process. It's done with what's known as a custodian to custodian transfer, which is a non-taxable, non-reportable event. Our back office talks to their back office and gets the funds sent over. And then you direct whatever investment you want. Again, part of self-direction. You're picking the deal. Advanta's not lining up deals for you. That's something that you have to bring to the table, like I said earlier. And we help you get that transaction done in a pretty timely manner. And also, just in the capacity of diversifying, like you said earlier. It typically takes someone when they want to set up an account to make their first investment. It can be as quick as 7 days. It typically takes about 10 to 14 days. But if you didn't hear me say that, a lot of people, when I have my first conversation with them, say, oh, what's this going to take? 6 weeks, 8 weeks to get this all moved over and done? And is there a tax consequence I'm going to have to argue with the IRS about later? The answer is no. And the answer is it's really quick.
Yeah, I've seen anywhere as quick as 2 or 3 days, right? If the investor is very timely and responsive when they're working alongside you guys to open up those accounts. But yeah, I think the good practice is about 7 to 14 days. And I think that's important because there's a lot of syndicates out there. And let's just use multifamily as an example that a lot of people are trying to self-direct their investments into. And usually those companies, if they're looking to invest in a single asset deal, there's usually about a 60-day raise period. So understanding the time it takes to open up an account so you can plan ahead is good. Now, this leads me into my next question. So let's just say I don't know what I want to invest in, right? I don't have anything to self-direct into yet, but I know that I want to be ready for it and I want to do it. What are the costs around this? It sounds expensive is what I hear all the time, right? Setting up another type of account, clearly they're going to want their fees and money as well. But let's just say I want to set up an account so that I'm ready to move the money from custodian to custodian when I feel comfortable that I've targeted investment I want to invest in. Can you walk us through that?
Yeah, I can definitely walk through that. I'm not going to get into the exact specifics of the cost right now, but someone that's watching or listening can reach out to me for our fee agreement at the time that they hear this. We have a very reasonable account application fee that's billed when I process the application. And then on that application, you'll see our fee agreement. It's page 4 of a 7-page application. You'll elect as a client whether you want your fees to be billed annually per asset you invest into, or quarterly based on the total value of your account with us. And that quarterly bracket, it's a static bracket. It doesn't fluctuate based on your earnings or any points on your investments. If your account is worth 0 to 15,000, we bill you this annualized, and you're billed on a quarterly basis. So 25% of this figure you see here is what you'll get billed each quarter of the year.
Yeah.
Aside from that, we have flat rate fees when we're processing a transaction, or if there's a wire involved, our bank conveys a wire fee. So just very generalized, very simple fees to understand. We put it out in front of our clients as early as possible so that they have a reasonable expectation and an understanding, and no one should have a reason to come back to Advanta later on and say, hey, you've got these backdoor fees or these behind the scenes fees that come up. We try to stand really firmly behind our fee agreement. It's reasonable. It's priced below a lot of the market in the industry. Just a general anecdote: for an average investor that just makes one investment per year, holds one investment throughout the year, we're typically only charging them roughly about $400. So we're really only making, $350 to $400 per client that we have, unless they're a client that has, 10 different investments and a lot going on with their self-directed account.
Yeah, and I love that. Price below market. I think that's the key thing, right? And that's my experience as well. You have to remember, wherever this money is before is probably being charged at these larger custodians somewhere between 0.8 and 1.25% for the assets under management, right? So when you bring this money over, for the most part, you're not being charged over there by the large custodian because that money has left. And this is just my personal experience. The fees that are associated, for me, I do the annual fee, and let's just use that 400 as an example. Whether it's a $50,000 investment or a $100,000 investment, that fee comes out less than 1%, which is, for the most part, usually far less than what that money would be charged at the larger custodian. So for me, the fees have always been a moot issue and not a concern for any of my personal investments as I've come over to self-direct.
Yeah, I appreciate hearing that feedback of, it is an alternative option and a cost-efficient option to those larger custodians, and really should alleviate some of the concern people have when they're deciding if they want to start self-directing or not.
Yeah, and then so to wrap up this topic, so who's making the investment? And we'll keep using multifamily as an example. Is Advanta signing those subscription agreements, or is the investor? Or how does that shake out for people that are unfamiliar with that?
So I'm going to answer your question and kind of go down a little bit of a separate track here in the answer. So feel free to pull in the reins when the time is right if you think you need to. So Advanta in general is making the investment on behalf of that client through their retirement account. So on all the documents, in 90% of cases, it'll list, for example, Advanta IRA for the benefit of Kurt Edwards, IRA number, and their number. And the tax ID number tied to that investment is going to be a trust tax ID number of Advanta IRA. So we're getting the client to mark the entire investment paperwork as read and approved, that they authorize us to make the investment. They're also executing one or two more documents to basically sign off that they've done their due diligence, that they are electing to make this investment or have Advanta make this investment on behalf of their retirement account, and that they are fully aware of the responsibilities and possible outcomes of this investment. That is, most investors go through that route of just holding the asset directly through the custodian. Now, the side route that I was about to reference is that some investors choose what's also known as checkbook control or single member LLC strategies, where they set up an investment vehicle that is an LLC wholly owned by their retirement account that they are the manager of, and Advanta funds an investment into that LLC, from which point the money goes to a bank account that you as the account holder have access to, and you make all the investments with those retirement dollars in the name of that LLC completely at your discretion. So if you're someone that wants that checkbook control and has the understanding of the additional onus and responsibility there, but prefers the additional flexibility and direct access, then you would be making the investment in the name of your LLC, executing the investment documents with the general partner subscription documents in the name of that LLC with that LLC's tax ID number. That strategy in itself is sometimes used to cut back on some of the fees that an investor would pay Advanta, because we have that one LLC on the books and they may hold 10, 15, 20 different investments all encompassed within that LLC. I don't really want to get too much further into it. I appreciate you for letting me at least go down that side route a little bit, because it is an important aspect to the answer and clarification on how these deals are funded and who holds what, how is held.
Yeah, no, I think that was perfect, Corey. Um, what do you think the most important thing to look for in a self-directed IRA administrator? For us, we partner with yourself and another custodian, and we like to offer a couple options for our investors that we've done a deep dive and vetted. But let's say somebody's out there on their own. What are some key things they want to make sure they check off or questions they want to ask?
I would definitely obviously look into some of the reviews that you can find online. That's always a good resource. Make sure that you're going with a company that has good customer service reviews. Just to toot our own horn, if you will, we pair each client with a dedicated client account manager. So once you have an account with us, you have a one-to-one person you're going to go to. And it's not like you're calling a larger wirehouse company where they may have 50,000 employees, and every time you call, you have to explain who you are and what you're trying to do and why you want to do it. You get familiar with your account manager. Again, as I said at the very beginning of our call today, I was in that role for about 5 years, and I had previous experience as a bank teller and so forth. So I really do appreciate getting familiar with my client base and knowing who I'm working with. And if I see their phone coming in, I can just say, "Hey, Mr. Johnson, you got another real estate deal you want me to get working on for you? Awesome. Let's get this done." Aside from the customer service, the educational component that gets put out there's a lot of companies out there in self-direction that maybe say they provide education. They may charge their client base for education. I know of a few companies that I think have like a $500 class that they do. All of the education we put out at Advanta is completely free. We put out 2 new webinars a week, typically with guest speakers and guest experts. We have a podcast we post weekly, and we have a blog as well. You're always going to see our educational content come free to you and accessible to everybody.
Yeah, I love that. And that's been our experience with you guys. Response time is always same day, usually within the hour. And it's been a pleasure to work with you. I'd love to talk about one other thing. When I'm on these calls, a lot of times, right, and I'll just speak for Hudson Investing, our minimum investment is 50,000. And you'll hear this a lot. I really want to invest in multifamily, but we're a little cash tight, or we just remodeled our home, or, we're about to, remodel our lake house. All of these scenarios still go back to they don't have the cash right now, or it would add stress to the family by making the investment from a cash position. And it's usually around that time that I ask them, have you ever thought to use your IRA or your retirement accounts, self-direct them? And that's usually the point in the conversation where you see that they're unaware that they could do that. And I think that's one of the coolest ways to do this is everybody's going to have different cash flow cycles or different reasons, along their year or their life. And having the ability to self-direct sometimes and use cash sometimes, I think is a great way to utilize in an efficient manner your cash resources to invest.
And just to add to that point, this is in itself a diversification tool for a lot of people. But even at that, you can partner your retirement dollars with yourself personally on projects. Depending on the syndicator, you may be able to agree to a full capital contribution with them or a capital commitment and make that, let's just say for rounded numbers, you commit to Hudson investing $100,000 investment. you may be able to work on the back end and say, hey, I've got 70,000 in my retirement account. I don't have the whole 100, but I've got 30 in my savings I'm willing to put into this deal, and structure things like that on a case by case basis. So there's always creative ways to build these investments out and to utilize these strategies. It's just having the right conversation with the people that know what they're doing and know about these things that'll help guide you in the right direction there.
Yeah, great point. I would say most of our investors, after we educate them, are actually using both vehicles, cash and retirement accounts, in every investment they make, right? Because the cash side of it does give them depreciation and benefits to use in the world right now, right? But then setting yourself up for retirement, whether it's in a Roth or a traditional and taxed or not taxed, they all play an important game of the overall picture. And that's why I love this topic. I've got one other question. I don't know if we've covered it or not. I wrote down, how do these vehicles differ from an investor using a savings to place in an investment?
They differ just in that you're making the investment with a savings account or your savings personally. There may be some tax write-offs that you can get from that for different things, but also tax expenses like capital gains or other things. The retirement account is kind of exempt from both. So you don't get the tax write-offs, but you also don't have the tax liabilities. Everything you generate within a retirement account that is tax deferred, meaning a traditional account, you do pay taxes on those dollars later in life. Whenever you take that money out of the retirement account, it's just taxed at your ordinary earned income rate at that time. So whether you're still earning a high wage or you're bumped down and you're at a lower income tax bracket based on how much you're taking out, that's really the differentiating factor there from that side. But as you just said, and kind of to the point there of diversifying and use both buckets, someone may want the tax write-off now for making a personal investment and having that appreciation depreciation scenario that the retirement account's not necessarily afforded because it's in itself its own tax sheltered entity and bracket.
Yeah, excellent. Way to clear that up. And I think it does tie into that last topic we were chatting about. That's really all I have, Corey. Are there any questions from your side that you want to ask, or are there any other stats out there like the one you presented at the beginning that I think are fascinating before we wrap things up?
I can't think of any other stats off the top of my head. That is my favorite. 4 is my favorite number. So the 4% of accounts that are being self-directed, or 4% of retirement dollars that are being self-directed, is just, it should be an eye opener for everyone listening today that you probably have that money that you can take a better advantage of if you have an expertise, which is another key term we've used throughout today's podcast. Use your expertise to the best of your ability. I've got years in this industry that I have built up a knowledge base that not a lot of people have. Whatever your industry is, if you've got a knowledge base built up and you have retirement dollars that you can, or you want to start building retirement dollars, invest in your industry or in some capacity, how you know to make better returns than the stocks, bonds, and mutual funds. Why not? Why not start now? Why not start today? Why not reach out and figure out what that looks like for you?
Yeah, Corey, and I know I'm doing my part. I can tell you the 4% number out there. I'm 100% self-directing all of my retirement accounts in a bunch of different ways, but I am self-directing those. So I'm doing my part to help increase that number and educate people every day as well. So thanks again for the time, man. We'll post all of Advanta's information at the bottom here of the podcast. And Corey, let's do this again, man.
Awesome. Thank you so much, Kurt. I appreciate you having me on the podcast. And I really hope that I've been able to share a little bit of information for the audience, whether it's beneficial for you or someone you know. Please share this with your friends, your family, whoever you think can benefit from it. And let Kurt and I know if we can help you in any personal capacity as well.
All right, Corey, have a good one.
Thank you.